Good morning, YouTube. This morning we're going to look at two specific commercial property deals that I looked at, and I'm going to share with you all the numbers, exactly what they wanted, exactly what I looked at to determine if I would try to do the deals or not, and how much money I could lose or gain on each property and what that's based on if I did the deal. So I'm going to get right into the numbers with you, and hopefully I explained it clear enough where it's not a math situation, it's more of a logical situation. And so if you understand the logic, don't really worry about the math. So this is the first deal. The first deal was a 5,700 square foot property that they would rent out to tenants. The tenant there at the time was running at a rate of $14.07 per square foot. That means per square foot per year, they're renting the property for $14.07, which is $1,700 a month. I think that's per month. So this is what they were paying. And so if you take that amount and you figure in a reasonable percent return of your money, that basically tells you the value of the property. And so that value at a rate of 6.7% return is $687,000 valuation of the property. Now, the problem we have at this point in the market is on a building that is 75% unrented, that is renting for $14 a square foot. They are pricing it as if it's renting for $20 a square foot fully rented. So the difference between the current rent and the amount of rent that they have and that number is basically what you would take as a loss to buy the building, or as a miscalculation or some bad decision that you made if you were going to continue this process. And so at $20, which is what they assume it would rent for, versus the $14 it's actually renting for, at full occupation, they asked $1.25 million, which is a 6.72% cap rate. So when I went in and I said, this is what they expect the value to be after you convert it to fully rented, to proper current rents, to fix it up and all kinds of other stuff, then the actual value today is $687,000. So basically, if you buy the building at their price, you have a great possibility of losing a good $562,000. That's a lot of money to lose based on a miscalculation. Now, let's say you were going to buy the property for the land, tear the property down, and rebuild something there that you were going to build. Or you were going to convert it for a single use for you to put your business in that thing. And it's worth 1.2 for you. I think it's worth 1.25 for someone that's going to put their business in there and kick everyone out. Or someone whose business is doing a conversion. I think it could be worth that much. But for me, that represents a loss of $562,000. So really not a good time to go there. Now, what this also represents is a misunderstanding of rates and the way rates are changing. Because when the base rate is 4% and your total rate is 4%, this is a fine cap rate to have. Okay? But when the rate's at 4% and your borrowing rate may be 6.5% or 7%, you're talking about a 0% return on this risk. Right? You're not getting paid for the risk in this situation because of the interest rates, and the price of the property has not yet been adjusted for that situation. So that means the timing kind of this deal is not right, or the seller has not realized that the property is not worth 1.25 and instead it's worth about $687,000. So let's go into the second deal here. This deal was a bulk of 20 properties in the area that I'm in, and here are the rents per month of all those properties. There's 20 of them. Total rents are $28,077, and again, they're asking $6.5 million. Now, if you look at their percent return they calculate, they say their percent return is 5 or 5.5%. but I went and I looked at their numbers. And in their numbers, they only take maintenance as an expense, not taxes and insurance. And when you take taxes and insurance out, it ends up with more like a 3.81%. Now, given that interest rates are 6.5% for this deal, you're looking at losing 3% per year that you hold this deal. Not a good situation. You could lose a lot of money on this. And so I hear some people say, yeah, I would do this if I had the money. Well, if you did this and had the money, you then wouldn't have the money. So having money is a self-perpetuating thing. You make decisions that allows you to continue to have money, and those decisions are generally the same ones that left you with the money in the first place. So if you look at this deal, they're asking $625,000 per house at a 5.5% rate of return, which is base, the lowest you could do. That puts each house at $225,000. Now, I'm more in houses than other things, so one possible thing I could do is at this 5.5, I buy 20 houses. I could flip around and sell 4 of the houses. And what that would do was I could sell them probably for $275 or $260, claim some gain, and net my rate of return up a little bit through that kind of a process. Now, right now that's pretty risky because you're talking about flipping a house in a market where houses are dropping and not selling very fast. And so this deal, they asked $6.5 million. That price at peak price, maximum that could be paid, is probably around 4.9 or 5 million, and that's at a 5% return with a 6% interest rate you're borrowing money at. So 4%, 5% return when your treasury is paying 4% means you're getting paid 1% on the risk or possible appreciation in that property, or illiquidity, or the costs. So you're really not getting paid at all to buy the property, and you should only make a move when you're actually getting paid in some fashion for making that financial move. You should not make a neutral financial move. So if these properties to you are worth $5 million, you'd never pay $5 million for them because that doesn't include your risk. If there's 10% risk, that's a $500,000 risk. That means you have to buy for $4.5 million if you think you control those risks or you have some advantage. Otherwise, you're pretty much losing money on the deal that you're doing. So on this property, if I was going to make an offer, I would have to look at my risks and things, but $4 million would be a great price. That factors in some of the things about interest rate risk that we have, and some of the things about the cost of the house going down. But definitely $325,000 is not going to happen. Anybody that buys it at $325,000 is counting on something that to make them money that I don't understand. And maybe they have some way to do it. Maybe they can jump in here and jack up rents. Maybe they can jack up rents, which I'm not going to do. I mean, if I took them over, at the year mark, you get a 5 to 8% increase in rents, maybe, based on inflation. But I wouldn't ever increase the rents higher than that. It's basically telling people to leave. And instead of that, I would just not renew their contract if I didn't want a certain tenant, if they were a bad tenant costing a lot of money. And so I wanted to show you this deal, so you could kind of understand what it looks like when you actually look at a deal for a commercial property. The numbers here are kind of high. 6.5 million I think is high, but it's all about ratios, internal rates of return, whether you're making money doing the deal or losing money, and what that can be based on. And so understand that on a deal, you're making money on the in or don't go in. So for right now, I can see that the thought process in the area has not adjusted to the new interest rates and new values of properties that have definitely dropped. And due to that, I'm pretty much accumulating money, paying down debt, putting myself in a better cash flow position. All 3 of those things I've taken some steps on. And hope this is valuable to you to see actual numbers on a deal and what it looks like and what the considerations are for that purchase. I'll talk to you all later. Like and subscribe down below, and bye.